Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, April 3rd, 2020. Well, we're going to take a look at some of the trading ops, some of the things that stand out to me right now, whether they're official trades, unofficial trades, setups, or actionable trades. We'll start out with the broad markets, do a quick overview on that. Nothing much has changed. We continue to trade in this trading range here, and what comes to mind right now to me is the word denial. Denial is not just a river in Egypt. It is actually a state of mind right now. What I think is going on. Again, I've seen such a huge disconnect from the fundamentals. Yeah, the market fell 35% recently, but I think we're going a lot lower based on this ongoing pretty much shutdown of the U.S. economy, or at least a good part of it. There's certainly some companies that are going to continue to keep going and keep their earnings consistent. But what I'm getting, I don't think they've priced in where we're at right now, and more so where we could be. Again, I think the market right now is looking at best case scenario. So I think we're going to take another leg down soon, and it's going to take a technical break to get there and to trigger that next catalyst. So where I'm looking at is right here. We have this little area of consolidation, kind of pinched between 247 and about 254 on SPY, and you can draw an uptrend line there as well. Kind of this little wedge, flaggish type pattern right here. We had that bearish rising wedge we broke down from before. We'll take a look at another board. Same levels I've been highlighting, bouncing between about 250, 50 on the top. A little bit more with some of those spikes now. Again, that's why I showed you that other board. We could certainly put a line up there that should be significant. We've had a few, 3 failures there on this 30 minute time frame I'm working off of lately here, and then we still need to take out that 244.93. Remember, we hit that yesterday, bounced up, successfully defended that support level with that just an intra-period break, but a close back above it. So there's 3 successful defenses of them. We rallied up, and so if we go down to it, 2 things. Number one, it is still significant support, more so than even before I had that line there. That line was there before we even hit it. Now that we have those reactions, if we get there, it's even more important. So either the buyers step in again, which I don't think they do, or they break it. And if they break that, look for a impulsive break, especially a 60-minute close, and that should open the door up for a drop down to 235. It's Friday. We'll see what happens. There's still a lot of pessimism, short interest in this market. The VIX has abated somewhat, come down off its those extreme 2008 highs. And I've talked about that before. Here, let me jump over to weekly chart in case I know there's always new folks coming into the site. So a couple weeks ago, I mentioned back here, look, we were at that extreme high. Said, the risk reward for, staying long or going long the VIX was not attractive. In fact, the VIX was likely to fall. And it's fallen quite a bit. So things like TVIX and all those VIX tracking ETNs have fallen. And a point I made, and I showed it back here, that was the high, all-time high in the VIX, and at least going back for decades. I didn't need to go back any farther than that. You can see even the last couple bull and bear markets right here. There's the dot-com bubble. It didn't even get that high. This right here, there was a dot-com bubble. So the point was that I made, it's that the VIX peaked back in the fall of 2008. The stock market did not bottom until March 2009. There was a lot more downside to come from there. So the point I was trying to make is the VIX can continue to fall with the stock market falling as well. So I want to point that out because most people correlate a rising VIX with a falling stock market and a falling VIX with a rising stock market. But the two, although that's usually what happens, not when you get to extremes. And because what happens is an extreme VIX reading shows extreme amount of put buying versus call buying, and that does what I talked about recently, effectively puts a floor in the market, at least for the time being, because there's too much put protection, protecting those people on the downside. And again, there's technicalities of, when you buy a put, somebody has to sell you the put. Those are usually commercials, professionals, smart money, institutional traders. And they're going to hedge up to protect their downside. They're not going to sell you a naked put. It's retail traders that buy naked puts and calls, meaning you have, or sell them, I should say. When you sell a put or a call, sell an option, what they call a naked option, that is probably the most riskiest high-risk trade out there. Your loss potential is unlimited on a put or a naked put or call option. So what the smart money's hedge up and they take the other side of it, which limits their risk. So anyways, it's all technicalities as to why the market sometimes when it looks like it should be going down doesn't. It rallies, and again it's just all clearing out of short interest and excessive put buying and all that. And then once that gets to wherever it needs to be in a bear market at least, then you take the next leg down. So okay, so enough on that. And, I'm looking at bigger picture stuff, using that short-term 30-minute chart to kind of hone down, but this is bigger picture stuff. It looks like our first wave down in the bear market. We had a little smaller wave there, and we're able to profit on a long trade on that, turn around and go short at the top, and then swing that short, the official short trade all the way down, close to the bottom, not all to the very penny, but we caught the bulk of both of those waves. And now, and in this one again recently, and now looking for another move down to at least come near test and quite possibly undercut those lows again. I think like the fundamental case is very strong that this market should be going down more and adjust to where prices need to be based on the lost revenues from corporation after corporation, what's coming, the unprecedented wave and surge in unemployment claims, people being laid off, and as I said, consumer spending. Forget about the near-term pullback in business. Consumer spending, I mean, it's all related, is 2/3 of gross domestic product. And so if you're a believer that these stimulus checks that everyone's getting is going to cause some and even move the needle in the economy. If you think people are going to run out and buy, they're probably going to hoard it. They're going to buy what they need, or they're going to replace lost income. Pay their mortgage, pay their light bill. So, anyways, I don't think the stimulus checks are going to do squat, and that's just my opinion. All right, we'll move on. That's okay. So that's the charts. That's it. Not much else to say in the last few days. I'm not posting frequent updates because when you're consolidating, trading in a sideways range like we have been. Here's that QQQ short trade we have. There's just not much to report. Let me just box it in here. Let me change the tool color. If I can do that, let's see, color, change that, and show you. That's it. Simple as that. Upside break, I don't think it's going to happen, but if it did and it's stuck, well, you have a big old gap to backfill. So I still think the upside is limited, and prefer to be short the market right here, and whereas a downside break of the range should open the door for our next target, and quite possibly our other target. The more we consolidate, the more you build up energy, and when you have these consolidation ranges like this, it's like a coiled spring. You have little consolidation periods, and then boom, you get the next big drop. Boom, you get the next big drop, and it can go the other way. Now, when the trend is bullish and the technicals are bullish, you consolidate, and then boom, it goes the other way. So this is the way I think it goes. Okay, on a related note, probably the most correlated trade that we have to our QQQ short trade would be SOX. Again, I need to impress that point that if you are short the semis, actually we're using SSG, the 2x short one, to give you guys that don't have the ability to short, and you want to use something SSG. Again, you can buy that, you'll go long, but I like to use this index here, this index tracking ETF SOXX non-leveraged, to give a bigger picture of the semiconductor sector, and it tells me that nothing's changed. The near term can be tough to call at times, especially when you're in these consolidation periods, but long term nothing has changed. This is a bearish chart. You had the trend line set up with the divergent high, give you that small wedge right there, negative divergence, and so far we had a breakdown. That was your sell signal. Then we broke this very important 218 support. That was a breakout of 1, 2, 3 triple top, just like QQQ did. Finally broke out, came back, tested it for a few days successfully, back tested the wedge, and it's just beautiful technical analysis. I know I hate to sound like a geek when I look at a chart. It's like an art lover looking at a Monet or something. It's just to me a beautiful form of technical analysis, or beautiful example there. Boom, hit that 218 level, bounce, back test, offering an second objective short entry, pull back down here, hit that 170 very well defined support level right there, bounced, and we're bouncing back to this 218 level, or we almost did. We came close enough, and as I said, that's where we shorted it, because I didn't want to. I think that's too obvious so far. That it's funny that the technicals are playing out almost perfectly. It's just, and I have no doubt that's a lot of traders using them. But again, in a bear market, you have two choices. You want to hold out for 218, sure, you get a better entry. Or if all eyes see that, then I prefer to short a little shy of that, even if I go underwater and not miss the reversal. And that's where we're at so far. So we're profitable on that trade. I believe it's profitable now. And then you have that 200-day moving average right above. And like everything else, it either works out or doesn't work out. But I'm doing this video to just say, right now, markets have been consolidating. That's when I imagine most people don't want to do anything, or they think it's bullish because it's holding up. I view it differently. I view this as every day goes by and we consolidate here, just one more opportunity to get short or get out of your longs, if that's what you're doing. And of course, if things go the other way, as I keep talking about, the fundamentals can change. Somebody can come out with some kind of drug, combination therapy, something, and they're working on a lot of stuff, and that mitigates or puts puts the brakes on the virus, and and then all of a sudden, if that happens, they get it out to people quick enough. People start going back to work. People start feeling safe to fly on planes again and jump on a cruise to the Bahamas. And great, then things are going to change rapidly in the market. But that's not what's happening right now. So, like I said, denial is the key word right now. I think wishful thinking for some. I'm a realist. I'm going to take the fundamentals and the facts for what they are, and say this is probably, we're going a lot lower. Even if the cure for Corona came out today, this is a technical breakdown on stocks from a very bearish pattern. And here we were in a rip-roaring bull market, and we had a similar breakdown back test of the wedge, and from that divergent high right there, the semis fell 28%. Again, in a rip-roaring bull market. This time around, this is the worst. That we're off to the sharpest start of a recession, depression, the biggest turnaround decline in gross domestic product, the biggest jump in unemployment, and the semis only fell only 37%. But when you look at market cycles, again, I go back for a long time. These are the trends. When the trend flips from bullish to bearish, this sector is this is the nature of this sector. At the top, when everything's roaring, chips are plentiful. The chip makers are pumping them out, and then all of a sudden there's an excess of inventory supply out there. Demand goes down, and then the prices correct accordingly. And there's 65% bear market on that cycle. There's a 35, and here's a last bear market, 68%. And then these are just the corrections in the bull market. I'm going to read them out to you. 28%. Roughly 35%, and it goes on and on and on. You can do this again in your own chart. 28%, and then that last one, as I said there, 26%. So right now, we haven't taken out the primary trend line, but I think it goes, and I think the cycle in the semis is probably over. Peaked, and so therefore you're looking at the next target down here about another 28% below, and ultimately before all said and done, I think there's a good shot, very good shot, we come down here, and that's about another 50% below, which would account for a drop off the highs of about, if I can grab that, might be a little high on there, about 64%, which is in line with previous bear markets in the semiconductors. Okay, and the nice thing about being diversified, and I've gotten a few more official trades out there lately, is you don't have to bat 1,000 on your trade ideas and your holdings, meaning you don't have to be right on everything, at least not at any point in time. You just have to be right on most of them. And so we have other things out there. If stock market rallies, maybe gold rallies too. And typically it's a risk on, risk off asset, but not always. We've been in a bull market now for years, right? Didn't the bull market just stop right here recently? So did gold. So gold was running right in line with the stock market. So in other words, it had a positive correlation in recent years, whereas quite often it has a negative correlation. Either way, I'm going to trade gold on its own merits, its own technicals, and there we are. We came within pennies, or basis points within the the third target already, but I did add an additional target on this recently because I remain longer-term bullish still, not just knowing that bull's in a gold market. Whether that bull market ends or not, only hindsight will, or that will only be told in the future. But as of now, simple stuff here. We've been in a bull market since late 2015 off the left of this chart, and that's just simply gold making in an uptrend, making a series of higher highs and higher lows, and so I think that's where we go. Let's look at the 60-minute chart. We had some bullish developments recently. This is our 60-minute chart of GC, gold futures. So here's the trend line that I've been highlighting, all these levels actually, but this trend line was taken out recently. So you had a couple things happen. You had a resistance zone right there from about 16.16 up to 16, what is it, 22 or 23. You had a support about 15.77. We kissed that support, went on, and so here's what I see right now. We broke out here. We had an impulsive leg up, move right there through the trend line. Then we broke out. Again, that was highlighted the other day, and set up in this flagging type action. That looks like a bull flag there. Broke out. It's not the optimal breakout. Usually you want to see impulsive buying. That's the nature of a bull flag pattern, but it's still, we're above the flag. So if that pans out, you take to get the measured target, you have your flagpole, which is a distance of the impulsive leg up added to the top of the flag, and then you take that and add it to the bottom of the flag. Either way, I think that'll pop us. If we can get up, I think it will pop up through 1652. It should take us up there to that next target in GC, about 1673. So that'd be about another 2% right there. And that's my next target, near-term target for gold, because I do think the stock market will close down today. I don't think people are going to want to go home long on the weekend. So I certainly wouldn't. And then that should benefit gold. What would hurt or help the gold trade would be the US dollar. So we're watching dollar futures here. A couple trend lines to watch. Here's a little small near-term uptrend line. To get a break of that, that'd be bearish for the dollar, which should help gold. And then you have this other trend line. So there's pullback targets. Right now we are in a near-term uptrend, but following this downtrend here, we broke out. So those are the levels to watch. Not a whole lot of resistance up here, but I'm favoring a pullback in the dollar. And we look at the other thing I like to look at is euro futures. Euro is the biggest component of the US dollar index at about 60, I forget the number now, 60 something odd percent weighting. So 2/3 of the US dollar index is all dependent on what the euro does. So, and I'm looking at the euro at support, not solid support, but decent support right here. You can see it at 10794 with a nice little potential bullish falling wedge pattern. That aligns with that uptrend line, uptrend line that I just showed you on the dollar futures DX. And so when we flip DX upside down, it's almost a mirror image of E7, the euro futures. And so boom, get that, pop goes the weasel, run up there, hit that trend line, probably get a reaction, and then right up here to this 109.89 level. If this scenario plays out, I will put very, very high probability that gold will hit that target I just showed you in that scenario played out. And look, this is not mere coincidence. This is why I love this stuff. Whether it happens or not, it is not mere coincidence that euro is set up in a bullish falling wedge pattern, pushing right against that trend line at the same point in time that gold is back testing that bull flag pattern. So what happens if one pops, if this pops, then gold should reverse off that. And if we get an impulsive move up in the euro, that should be that impulsive move up in gold, and likewise be that impulsive move down in the dollar futures. Where did it go? DX. Here's your little trend line. Boom, come down there, hit that 100.012 support level, and quite possibly that next one down at 99.117. I skipped over NQ and ES because again, same story. There's not a lot to report. I'll cut back on my updates if there's we're in a consolidation mode, but that's it. That's NQ right there, Nasdaq 100, still favoring this. Breakdown below the trend line would be your sell signal, and on ES, similar story. There's your trend line. I could put a make it a price channel like I had on NQ. Doesn't matter if you put the upper line there or not. Most important line to me right now is this one. Pop that, and you have 2460, big level just below. So to be safe, you wait 2460 to go. I mean, you could certainly. I think you could be long, short now in anticipation of that. Add on the break of the trend line. Add again if you want. Depends how you trade for an active trader. On a break below 2460, minimum target down there. 2386. But again, we've been coiling and building energy. We could have a bigger move down here to 2331 in pretty short order. So you got to move quick on these if you get it. Like I said, we're not going to meander around like this forever. You get these breakouts and you get these big impulsive moves, and you either have to be in front of them or get in early, because the market doesn't like to let in people that are a little wishy-washy on their entries in a fast-moving market like this. Okay, sugar, just quick update. Still looks fine. We had the breakout yesterday of the smaller wedge right here. Hit that first, target, those two targets right there, 100.073, and kissed the trend line, pulled back. But we're still above the breakout point. So would like to see this PPO get above that zero line right there. I would also like to prefer to see, not to see a back test of the wedge, although it is certainly possible and still within the realm of keeping the charts bullish. When I'm talking about you extend that line here, we can come down, undercut, make a marginal new low, but look, any new low anytime soon. That's why I'm giving this one a little room. We'll still have strong bullish divergences in place. In other words, the PPO, the RSI would look like that. PPO would look like this or better, if we made a marginal new low right there. So I just want to let you know I'm very much open to that. And and if that happens, you get a reversal. You still have the next buy point or objective long entry above those two levels right there. Boom, and that would open a door for a move up there. And there it is, our official proxy. ETNs or ETFs are always a proxy because I know official proxy because I know a lot of traders don't have access to futures. SGG up 2.34% today. Divergent low, almost confirmed. We get a little more upside. We will have confirmed that with a bullish crossover, on the PPO. Like I said, the first target was hit. It was a quick run, but I'm a stickler with the sticking to for the official trades. If a stop is hit, I don't care if it was just a little kiss of that stop. Brief kiss, wonky little run up like this, I count that as a trade stopped out, and if a target's hit, target's hit. And now, again, that still makes it's still a resistance level. So if we power back up, for those of you that, when I'm saying this, for those of you who weren't able to catch it yesterday because it happened fast, we could get up there again. That's still the next target again. We'll probably get one more reaction there, is my guess, but it has been hit now, so it also opens the door for much more. So I'd like to see a little more. The commodities need to have a little more work to the upside. As you guys know, I'm warming up to those. I have been for a while. And it's all about, to me, relative value. We're in a bear market in the stock market. Things are not good there. And when I look at these long-term charts of commodities, they've been in a bear market. They're beat down. Corn, it's an ETN, so it's not going to look the same as that chart I showed you earlier today on this trade setup with corn futures, which are at long-term support. So that was a basis for this trade. In other words, we don't have a buy signal yet. There's two ways that I go long a stock typically. Now, sometimes I'll anticipate a breakout before it happens, but typically I go long on a breakout above a well-defined bullish chart pattern or resistance level. For example, there's probably some examples back here. Yeah, we had a couple trades before. I don't know where the entry were, but we have divergent lows maybe back here. These must have been official trades because I have the targets there. It was probably maybe on that downtrend line there, and sometimes these trend lines I use different boards. This one was probably on something like this, a breakout of there, or I might have took it at support and then hit those lows. You can see this is simple stuff. Swing trading, it's my style. Look for these divergent lows and then buy signals or objective entries on pullback to support. So that's again what I did here. You don't see it on this chart because I use the chart of the corn futures and I use the weekly chart, but corn futures are trading at support there. So and then like I said, the next objective entry, if we do run up to that first target, maybe get a pullback, then break above that level would be the next objective long entry, because you either, again, two objective long entries are pullbacks to support or breakouts above resistance. And in this case, so far it was a pullback to support, but I also gave you guys an alternative entry for those of you that say, well, Randy, why are you going long corn? It's in a downtrend. Trend is your friend, blah blah blah. Well, if that's that's what you want to do, I understand it, and that's why I listed out both corn futures and corn. This is the same ETN right here, CORN, with this bullish falling wedge pattern. There's your same downtrend line. You can wait for a pop above that. That's, like I said, the higher probability entry, although at a less favorable entry price. You're waiting about almost 2.5%, almost 3% or so from where it was posted today before you even get to that level. So and what I meant by a scale in entry, you could take a partial position here at that long-term support, add maybe a little more downside but not much more. Preferably you want to add on strength on this position. In other words, a breakout above that level. You could maybe then bring it up to a full position if you only took a starter today. And then for corn futures, CC, I gave the same thing here. I'm going to move this line down. We're going to continue to diverge if we fall lower for a while. We'll keep these divergences intact. And again, so if you want to kind of hone in and nail the timing on it, wait for a break right here on ZC corn futures, break above this downtrend line, a little wedge pattern there, and you can see the potential targets marked. And I'm really close to making cocoa an official trade. I highlighted it in the video, one of the videos or more the other day, is liking cocoa. We're looking at CC. These are cocoa futures. And so today it was an objective long. I almost posted it here, but I'm doing the video where it's just a hair above it now. Where we pulled back to this bottom, this trend line. So we have this little triangle pattern. Just below it, you have price support there, about 226. I think that is, yeah, 226, yeah, okay, so that's price support with a little triangle there. So the trend line as well, if we punch under the trend line, you have that price support just below. And then same thing on the upside, you have resistance at the top of the triangle pattern, and just below it you have the 2303 resistance level. So here's your setup. You know, if you want to take a starter position in anticipation of a breakout, you can do that. And if you do that, you buy it here or at the bottom right here. You don't buy it right here if it rallies up. At that point, you wait for the breakout. But if you do go long here, then your add-on is going to be on a breakout above 2303, or you hold off for a breakout there to take your full position, a starter position, or an entire position. So that's how that works. Now, if it breaks down, that's not going to be good, obviously. That would be a break of support, and anything other than a whipsaw signal, and that's a possibility, because if we look at this chart and try to see what might happen in the future if that did break down soon, it'd probably be impulsive because it's a well-watched level. So I don't think we'd limp down. I think you'd see a pretty sharp run down. Now, it could set the stage for a bear trap, aka stop raid, and if so, here's what it would look like. Draw these lines out here. We turn around, get a compulsive dump below there, but then followed by a reversal, and that would give us, I might have moved that line up too high, but we'd have to kind of visualize what it would look like if it happened, and it would look something like this. The indicators would make another leg down, then they would reverse, putting in strong positive divergence. We don't have positive divergence yet because you need to make a lower low in prices. So that's the alternative scenario right there for cocoa. So I'll for the time being, I'll hold off on the official trade for that because we already have a couple commodities on the site. We have sugar and corn. Wheat usually runs with corn, so if you're going to take one, you might as well take the other. Those two tend to trade often together, not so much right now, but the bigger picture you'll see there's wheat. We traded this one quite a bit in the past, and there's corn right here. And actually, take that back. Corn's been dropping lately. Most points in time, you go back, and I've noticed that wheat and corn go together because they're alternative or competing food sources, especially for livestock as well. But either way, I gave you the setup. I'm favoring corn right now. And then cocoa, which we were just talking about, if you don't trade ETFs, or futures, I'm sorry, then you have the ETN here. Forgive all these lines. I know it's a busy chart. I'll just show you the most salient level here is this uptrend line right here. NIB, again, cocoa ETF. Simple stuff I pointed out the other day. Wash, rinse, repeat. Rallies off this every time you pull back to this trend line. At least in the past, you've had significant rallies, and so it's as simple as that. You can buy it at support. If that little 60-minute chart does give you that whipsaw signal, it might do something like that. And again, if we break this trend line and then recover it quickly, that would be a bear trap. That'd be pretty bullish, and I think we could see a nice rally in NIB. So again, this is keeping with my theme of diversification, asset allocation, and where to prosper in the bull market or bear market, or both. See, that's the beauty of this. I could be wrong on my call that the stock market's going lower from here, and maybe these commodities play out, maybe they pan out, or maybe the gold trade pans out. And again, that's the whole don't put all your eggs in one basket kind of thing. Okay, and the crude oil, told you guys this morning, put out a post. It's an unofficial trade, but I thought it was an objective short, and it was so far good for that. It was up here. You have a nice resistance zone between about 27.59 up to 28.47. So we'll call that 27.60 to 28.50, if you will. And negative divergence, just like down here, you had a big very well-defined trend line that was pointed out. You had the positive divergence recently at the lows, and then you took out the trend line, and from there, gold or crude just pretty much hasn't looked back, mounting a rally of what is that? What does that pop-up line say? About 40% or so off that breakout point from the trend line that was highlighted last week, and I think earlier this week as well. So that was it. This was the biggest single day gain in crude ever right here. And there's your uptrend line to watch. So to me, it's a pretty clear target, and I'm going to show you something else here in a second. But that was it. Short today there, and so far I can only do this to measure it, but I'm going to have to take that line, shrink it back up. Yeah, maybe about an 8% pullback so far off that trend line. So, and I think there's still more downside to come. You have 25.19 price support plus the uptrend line, whichever comes first. I'll probably cover right off the trend line there, but that's still what I'm targeting. And then I gave you on that an alternative for those that don't trade futures and can't short either. You can buy SCO. And that one is, let's see from where it was today. This was it right here. So I'm trying to recall where it was. Oh, it was in pre-market. So yeah, the gains, we've already had the gains. I was wondering why that looked funky. I showed you this one in pre-market. And so and that's why I say, I love trading futures. You're seeing the whole story. It's like, if any of you fish or boat, you know the benefit of polarized sunglasses. You put them on the water compared to a pair of non-polarized glasses, you can see through the water like you have x-ray vision. It takes the glare off the top. You can see the bottom. You can see structure, fish that you cannot see with regular sunglasses. That's what looking at pre-market trades, after hour trades, and futures, because you don't see any of this. It's not reflected when you're looking at a regular session chart. So there was a nice setup there, as I posted this morning, a pullback to that 1841 support with positive divergence right there. And so far SCO has bounced about 21% just since this morning right there. And it's two-time leverage, but again, that's a nice bounce and still probably headed up there. Now, here's what I wanted to show you guys. Let me turn off the, we can leave it here for now. No, let me turn those off. Edit chart properties on the outside. Okay, I had an Alexa alarm driving me crazy there. Let me go to USO is what I wanted to show you. Somebody asked today in the thread on that trade setup, what I do. I'm long USO. Well, I don't know if I think it was he or she was long from this. We had a trade. I was story of my life on USO lately. The official ones are a day late, dollar short. That one was stopped out, but that's fine. I'm glad that we did stop out because it took kept going down from there. But the same price targets are in effect. That back then I had T1 at 559, and that was hit. And it was hit again on that yesterday's biggest one-day move ever in crude. That was almost to the penny where we hit, and then we had I think a 15% pullback from there. That's what I said. Yeah, about 15% pullback, and then right back to that level now. So the point is that this morning and today crude was at futures were at resistance. So was USO, and it's the same resistance level that was highlighted back here. Again on that last official trade, which went on to be hit right after that, and then to get hit again, and then to get hit again. So what is the point? Well, that's a big gap. That wasn't just some random number. The line was placed at 562. So I had my price target a few pennies below it for a safe margin, and the high today was 567, and no, I'm sorry, that was yesterday. So there it is. So there you can see the divergence, and there's still a potential target. So what I said to that that member is, look, if you're holding out for more, and it could be the near-term trend right now is up, just raise your stops to protect profit. If you were in anywhere, even if you took it where we took the last trade, it's still very profitable. I'm trying to recall where that one was. That makes no sense. If the stop was here, we wouldn't have entered there if that was the first target. I'd have to revisit that. Maybe we went somewhere by here. I might have changed that stop and moved it up at the time. Oh, wow. Long week, guys. I have multiple boards here. You can see them over here. I'll show you. I'm always talking about multiple boards right here to the right of the chart. And I was on an old board from an old trade a while back, and that's why none of that made sense to me. I was trying to figure out, this was our last official trade right here, and that was it. So here was our stop. We entered here. I have it up on another monitor. Let's take a look at that. That was the setup right there. We went long at that trend line, targeting 514, and then 548 was our second target. And so go back to that chart. That was it. And so we hit our stop, then went down here, went on to put in an additional larger, much larger, actually we didn't have divergent low there. We put in that bullish divergence that I had pointed out afterwards on crude futures, and saying that, it was just a matter of when, not if, a big short, explosive short covering rally was coming, and that was it. So it went from there and boom, popped up. And what I wanted to get at is these are the same targets that I had for this last trade right there, 548. So that was the target that was hit yesterday and again today, and its resistance, because it is that huge gap right there and another reaction. So we have a lot of reactions. So what I'm trying to say, this is a very significant level for crude. I expected a pullback, and we've already gotten a pullback. I suspect it's going to be a little bit more. So if you took that trade, there you could just trail down, protect profits. No reason to let it get away from you. And if crude does manage a breakout here, it'll probably coincide with with the stock market holding up today, maybe into early next week. Otherwise, if the stock market drops, we'll probably see crude come on down and backfill this gap right here. That gives you a pullback target right there to the former first target level, which was at the actual resistance level. I set that one tight. 514 is where the line was, and that's where our first target was on that last trade, and you can see that's where we parked yesterday at the close as well. So that's it. Sandwich between, or pushing against, resistance right now, with that support level below. If it can pop above today's highs, opens the door up to that potential third target there at 642. Still very much have my eye on Costco, as I mentioned the other day, among other companies, for shorting ops. Looking at this big divergent high, I think there's a lot of downside to come in Costco, and I may add that one on as official trade. I may even put it on as a setup before we head into the weekend, but there's targets. I need to add one more line right there. And another one that I'm eyeing again is Netflix. Netflix, I've pointed out. Well, this is a long-term chart on Netflix right there. You can see this little breakdown here. We broke the primary trend line, back tested, and then broke the secondary trend line or wedge, and we're back testing that. That offers an objective entry there. And Netflix, I've labeled the 383.81 level the golden shorting line. We've had numerous official and unofficial short trades off that level, starting with this one. This was an earnings induced gap down, waited patiently that day for a bounce back to that level for a gap. Remember, there was something there on the short. Yeah, that was it. Was resistance there. We shorted it, swung it down. The targets were hit somewhere in here. Then we shorted it again here, swung it down. T1, T2, T3 hit. We've caught that trend down. I mentioned it every other time that it's hit that level is the golden shorting line, objective entries. And there have been just numerous. Look at that. That's over 2 years now. And most recently, I mentioned it here again on the site. Back there, Netflix at the golden shorting line, and objective short entry. And from there, it fell to the recent lows about 25%, and we've come full circle back there again. I know everybody's saying Netflix is a great stock to own right now because everyone's sitting at home watching TV. I was about to cancel my Netflix account literally a couple weeks ago. I never watch it. My kids have gone through everything on there. The quality of everything they have is awful because all the studios stopped giving them rights to the good stuff. Disney wants to stream their own stuff. All the studios want to stream their own content now. They saw Netflix as a threat years ago, so Netflix had to create its own content. I could go on. We all have our own opinions. I'll finish binging season 3 of Ozark, and then I'm going to cancel. Or no, everyone's telling me to watch that Tiger series that's out there now. I haven't seen that, so maybe I'll watch that, and then it's over. My point is, look, Netflix is, we're in a bear market, and Netflix is here at resistance. I don't see a breakout and then a surge. This is a multi-year trading range. If it breaks out, probably be a false breakout like this one here. But look, whether I think the fundamentals are good and the technicals are good or not, it's simple. If you short Netflix anywhere around here and you want to give it room, I'm talking to give it a room trade to swing down to this trading range, it's all about risk reward. So maybe the trade doesn't work out, but you short it, you're targeting about a 40% drop over the next 6 to 12 months, maybe even sooner. So with a 40% drop, you can easily give yourself a 10% stop loss right there would be a 4-to-1 risk-reward ratio, which is an excellent risk-reward ratio right there. I'm holding up, if you can see the pop-up box to the left, that's about 10%. You could even keep it tighter, maybe around 7%, but what I'd probably do is use a stop on a daily close, because if you get a fake out, false breakout, it'll probably go up intraday and then reverse after that. So I'd prefer a end of day stop, and maybe I'll add this one as an official trade too. Again, it's been official, unofficial, and it really it's 6 to 1, half dozen to the other. I do these videos. If I like something, I'll tell you. I'll try to gauge and let you know my conviction on the trade, and sometimes the matter of getting an official trade out or not, there's different things. It's either the time involved in marking up the charts, identifying the price targets, cleaning up the charts. I have to go create a new board, one without any lines on it, make it nice and clean so it doesn't look so busy like this. And that takes time, so I'll just throw these out there. And then the other thing is sometimes there's overlap. If I already have 2 or 3 trades on in a certain sector, let's say semiconductor stocks, if I'm long or short the semis via the ETFs right now as we are, and then I add Intel, and then I add AMD, well, there's overlap there. You're either going to be right on your semiconductor sector short, and then you're going to be right on those other 2, or you're going to be wrong on all 3, because birds of a feather flock together, especially with the semis. So that's one example why I might show you additional trade ideas and not add them as official trades. But what I am going to do is wrap it up here. That's again just trade ideas, things I'm watching today. Gold looks good, I think, and still, especially for a longer term, but also maybe a short-term trading up there. My convictions on the short-term move aren't as high, but I do feel very good about our long-term trade. We're clearly profitable in that one already. What else was I showing you? Oil, oil you're going to need to actively trade. I don't see any time. It's not time to put a swing or trend position long or short in oil at this point. All right, I'm going to go ahead and wrap up here. I keep getting a reminder from Alexa to do something here. The alarm has, I've snoozed that timer 3 or 4 times during this video. I got to get back to that. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.